Let's talk about a topic that can really change your life: credit card debt. We're going to explore strategies to pay off that debt and, more importantly, to stay out of debt for good. First things first, let's talk about why credit card debt is so problematic. Credit cards typically have high interest rates, often around 15% to 20%. For example, if you owe $5,000 on a card with a 20% interest rate and only make the minimum payments, it could take you over 15 years to pay it off and cost you more than $10,000 in total. That's twice the amount you originally borrowed. Falling into debt is incredibly easy. Life happens. Medical emergencies, unexpected car repairs, job loss, or simply not budgeting correctly. It's common to turn to credit cards in these situations. They seem like a quick fix, but without careful management, that debt can quickly spiral out of control. Once you're in debt, it becomes a vicious cycle of making payments, accruing interest, and feeling the weight of financial stress. Why is staying out of debt so important? Debt limits your financial freedom. It means part of your income is always going towards paying off what you owe, rather than being used for saving, investing, or enjoying life. Being debt-free allows you to save for emergencies, invest for your future, and have the peace of mind that comes with financial stability. Now, let's break down some effective strategies to tackle your credit card debt. 1. Create a budget and stick to it. Creating a budget is the foundation of any debt payoff plan. Start by listing all your monthly income and expenses. This will help you see where your money is going and where you can cut back. For example, you might realize that you're spending $200 a month on eating out. Cutting that in half gives you an extra $100 to put towards your debt. Take the time to categorize your expenses. Fixed expenses like rent, utilities, and car payments, and variable expenses like groceries, entertainment, and eating out. Identify areas where you can reduce spending. Maybe you can cook more at home, cancel unused subscriptions, or find a cheaper cell phone plan. Every dollar you save can go towards paying down your debt. 2. Build and stick to an emergency fund. Aim to save at least 3 to 6 months worth of expenses. This cushion helps you avoid using credit cards for unexpected expenses like car repairs or medical bills. Start small if you need to. Even $500 can make a difference. Having an emergency fund means you don't have to rely on credit when life throws you a curveball. For example, if your car needs a $600 repair, having an emergency fund can cover that cost without adding to your debt. 3. Pay more than the minimum. Paying only the minimum amount due each month is a trap. It might seem manageable, but it extends the life of your debt and increases the total amount you'll pay due to interest. Let's say your minimum payment is $50. If you can pay $100 instead, you'll pay off your debt much faster and save a lot on interest. 4. The Debt Avalanche Method. The Debt Avalanche Method involves paying off debts with the highest interest rates first. Here's how it works. Make minimum payments on all your debts except the one with the highest interest rate. Put any extra money you have towards that high interest debt. Once it's paid off, move on to the next highest interest rate. This method saves you the most money in interest over time. For example, if you have 3 credit cards with interest rates of 20%, 15%, and 10%, focus on the 20% card first. Once that's gone, tackle the 15% card next. You need to be patient with this method because you might not see balances drop quickly at first, but it's the most cost-effective in the long run. 5. The Debt Snowball Method. The Debt Snowball Method is a bit different. Instead of focusing on interest rates, you focus on the smallest debt first, pay it off quickly, then move to the next smallest. This method gives you quick wins and can be very motivating. Say you have 3 debts, $300, $1,000, and $5,000. You'd pay off the $300 debt first. Once that's paid, you move to the $1,000 debt, then finally the $5,000 debt. The idea is that knocking out smaller debts first gives you a psychological boost. The quick wins can keep you motivated to tackle larger debts. 6. Balance transfer cards. If you have good credit, you might want to think about a balance transfer card. These cards usually come with a 0% interest introductory period, usually 12 to 18 months. Transferring your high-interest debt to a 0% card can save you a lot of money in interest. Just be sure to pay off the balance before the introductory period ends, as the rate can jump massively afterward. 7. Personal loans. Another option is to consolidate your credit card debt with a personal loan. Personal loans typically have lower interest rates than credit cards. By consolidating multiple credit card balances into one loan with a lower rate, you can save on interest and simplify your payments. For example, if you have $10,000 in credit card debt at an average interest rate of 18%, consolidating it into a personal loan with a 10% interest rate can significantly reduce the amount of interest you pay over time. Plus, having a single monthly payment can make managing your debt easier. 8. Increase your income. If you're serious about getting out of and staying out of debt, increasing your income can be a game changer. Look for side gigs, freelance work, or part-time jobs. Even an extra $200 a month can make a big difference. For example, delivering food, tutoring, or freelancing online can all provide additional income. Think about your skills and hobbies. Can you turn any of them into a source of income? Maybe you're good at graphic design, writing, or coding. Websites like Upwork and Fiverr allow you to offer your services to a global audience. Or you can look into local opportunities like babysitting, dog walking, or house sitting, which can also help you earn extra cash. 9. Negotiate with creditors. Don't be afraid to negotiate negotiate with your credit card companies. Sometimes they're willing to lower your interest rate or offer a settlement if you're struggling. It might seem daunting, but it's worth a try. Explain your situation and ask if there's any way they can help you reduce your debt. You can start by calling your credit card company and asking for a lower interest rate. If you've been a good customer with a history of on-time payments, they might agree to lower your rate. You can also inquire about hardship programs that might offer temporary relief in the form of reduced payments or interest rates. 10. Use windfalls wisely. If you get a bonus at work, a tax refund, or any unexpected money, use it wisely. Instead of spending it, put it directly towards your debt or emergency fund. These windfalls can give you a big boost in your payoff journey. For example, if you get a $1,000 tax refund, applying it to your highest interest debt can reduce the principal balance massively and save you a lot in future interest payments. It might be tempting to splurge, but using windfalls to pay down debt will benefit you much more in the long run. Are there any tips that you would add to this list? Let me know in the comments. And if you found this video helpful, don't forget to like and subscribe for more like this.